It's frustrating. Buying quality businesses at reasonable prices is frustrating when you look around the market and everything seems to be at a premium. It seems like every day a new high is hit in the S&P 500. The supposed September market dip was a mere blip in the S&P's quest to smash all conventional wisdom. But as dedicated investors, we can always find something that is trading at a fair price. And when that happens, you might as well buy it. So today, I'm discussing the stocks I'm still buying despite a market powered by jet fuel. Welcome to the Quality Investor. The stocks I'm covering today have seemed to be left a bit behind the rest of the S&P. Remember, I'm buying these because I believe they are trading at a valuation that is reasonable. It is based on my own DCF and risk tolerance. It is important to have your ideas of what the fair value is of a business because we all have our own investment profiles and goals. Now, to be clear, I think there are a few stocks in my portfolio that are trading fairly reasonably. However, these are two stocks and one ETF I'm actively adding to for a few different reasons. I think Visa is trading at a decent valuation, maybe a little closer to being out of my margin of safety, but I'm not adding to it because I don't want it to become a bigger part of my portfolio. It's my second largest holding, but it is about to be my third. That's because the stock I'm actively buying, I believe, has better long-term growth potential. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. My basic point is that how you want your portfolio constructed plays an important part of what you add on a continual basis. If you're happy with a position, don't add to it for the sake of doing something. Only add to positions because it fits the larger narrative of what you want your portfolio to be. So the two stocks I'm buying are two stocks I want large positions in, and that's what I'm aiming to do. The ETF, on the other hand, fits another criteria for my portfolio in a slightly different way. I'll get more into that a bit later in the video. So what I want to do is quickly show you what is on my main watch list, and then I'll get into the reasons I'm buying the two stocks and ETF on an active basis. Without further ado, let's take a look at the watch list. This is my current watch list. Every stock that you see here, I've been patiently waiting for it to come down to a reasonable price. I periodically run valuations on each of these businesses, and right now, everything is just trading a little bit too high for me based on my DCF method. I'm just not comfortable buying into many of these businesses at the prices they're trading at. So like the great Warren Buffett says, this is when patience matters the most. Sometimes we're just itching to buy, but there's really nothing great out there to add to your portfolio. MasterCard, Netflix, Intuit, S&P Global, Booking Holdings, Moody's, all these are pretty big names, but a lot of these have certain things in common. Each one of these businesses, in my view, has a very identifiable economic moat, and very wide moats at that. MasterCard, the other half to Visa. Netflix, in my view, has pretty much won the streaming wars. S&P Global and Moody's are a duopoly. KLA and Lam Research, they're semiconductor equipment manufacturers, but that is an industry that has extremely high barriers to entry, and they make extremely specialized products for a certain part of the semiconductor manufacturing process. Cadence Design, similar to KLA and Lam Research, except they're on the software side. Fair Isaac, we know them more as the FICO score. And I talked about this business recently, Zotis. But another one I like a lot is IDEXX Laboratories. They make diagnostic equipment for animals. The other thing about these businesses is I understand them. I feel like I can reasonably predict their cash flows. They're in industries that are also somewhat predictable. One thing to point out though, is I may have missed some. Despite my hesitance based on valuation, Fair Isaac in the last year has returned 128%, Netflix 93.6%. In fact, all of these businesses have done very well over the last year. The two that are lagging the most are Qualys and Lattice Semiconductor. Again, semiconductors, they've been very volatile lately due to overall trends in their market. And Qualys, for some reason, they're in the doghouse. They have increasing cash flow, they have increasing earnings, they have increasing margins, but yet they're out of favor by investors right now. So this is my basic watch list. This is stuff that I really do want to start adding at some point to my portfolio. I'm just really waiting for that correction to come in and get us down to some reasonable prices for these businesses. That said, I'm actively adding to a few positions in my current portfolio, and these 3 stocks are what I want to discuss today. Like I said, there are 2 stocks and 1 ETF. The 2 stocks are Adobe and Google, and the ETF is JEPQ, JEPQ. So let's start out with Adobe, ticker ADBE. To me, Adobe is a quality compounder. They're a SaaS business, they have a subscription model, and they have a product suite that is the industry standard for their customer cohort. Not only is their product suite the industry standard, it has very high switching costs. Once people learn Adobe, they're not going to switch off to something else because that means they have to relearn their entire set of tools. So as you can see here, ever since Adobe switched over to their subscription model, they've had nothing but steady growth for their revenue, gross profit, and operating income. Now I'll say their cash flow has teetered a little bit in the last couple of years, but I want to discuss what's going on right now in the trailing 12 cash flow. You see, right now they're a bit out of favor by the market. There's a lot of fear mongering out there that basically says AI is going to make the SaaS business model obsolete. But I think the opposite is going to happen. I believe that Adobe is going to be one of the leaders in AI once it's all said and done. They've developed many AI tools already as add-ons for their existing subscriptions. So they're already starting to monetize their AI offerings. And what we're going to see as well is consolidation in industry. Sure, there's a lot of AI startups out there right now, but like Microsoft gobbled up a lot of competitors in the 90s, the bigger players are going to gobble up the startups as they mature in their valuations. As long as Adobe makes acquisitions that are a complement to their core offerings, they're going to be fine. And back on that cash flow is a little bit down on the trailing 12. Well, it's at $6.5 billion. There was a one-time event that occurred for Adobe in Q1. They had to pay a $1 billion termination fee for the Figma acquisition that fell through. Add that $1 billion back to their cash flow, that's a $7.5 billion free cash flow in the last 12 months, which puts them back on growth trajectory. But when we're forecasting for the future, you have to take these one-time events out. So Adobe's free cash flows, in my view, are fine. Adobe's also expanding their margins. Gross margin up. It's actually close to 90%. Operating margin close to 36%. That free cash flow margin, that's only down due to that $1 billion one-time event. But all their other important metrics, look at their return on invested capital. Their ROIC is nearly 80%, and they have an ROCE of 33%. That's incredible return on their invested capital. They're basically getting almost 80 cents for every dollar invested in their operations. That's an incredible return. Very profitable company. So I'm very happy that they're out of favor by the market right now. They're currently trading at $495, and I'm going to keep adding until they're back up into the $525, $530 range. Very attractive at these prices. The other stock I'm actively adding to is Alphabet, ticker GOOGL. Of course, it's Google. And as an investor, how can you not love Google? Right now, they have a 23.4 PE ratio. Google has a forward PE of 18. They're at a very attractive valuation right now in the market. For some reason, they are very out of favor by the market. Personally, I think it's because of some of the legal wrangling going on by the DOJ, threatening a breakup and whatnot. I'm not going to speculate on whether or not that's going to happen or if that's going to be a good thing for an investor or not. You can find opinions out there arguing both sides. But one thing about the DOJ threatening breakup, litigation like that is going to take years. In the meantime, I want to load up on Google because it is very attractive right now. Trading at $163.24. Every single quarter seems to be growth on top of the last quarter. You can see their excellent revenue, gross profit, and operating income growth here. Very healthy growth on all the major metrics on a compound basis. Buying back shares at a very healthy rate. And they've been making very big investments on a CapEx basis into their cloud offerings, specifically Google Cloud Platform. Now, Google Cloud Platform just recently became profitable, and it's growing at 20 to 30% per quarter. As it gets bigger, it's the third largest cloud data solution in the market right now, behind AWS and Azure. But as it gets larger, it's going to take market share and it's going to scale. And that's going to expand the margins of Google's business even more. They already have very excellent margins, but the scalability of their cloud business is going to expand that margin at an even faster pace. And as an investor, I'm going to be here for it. they also just started paying a dividend. So we're going to get excellent dividend growth on top of growth that I think is going to far outpace the S&P 500 over the next 10 to 15 years. And speaking of those margins, you can see the gross margin was a bit of a downswing in the last 10 years, but it's back on the rise now. The last fiscal year is at 56%, and their operating margin, 25% 10 years ago, now it's at 27%. Their free cash flow margin also trending back upwards, and they have excellent ROIC and ROCE. Their return on invested capital is at 25%, and they have a 31% return on capital employed. Excellent return on money invested into the operations of the business. Great return for investors. If you look at the profitability averages, this chart at the top here, you see on a 10-year basis, the ROIC, for example, has an average of 18%, but in the last year, its average is at 25%. My point is, they're pushing their average up because the business is fundamentally strong, and that growth is going to continue for a long time. And I haven't even touched on the search. Nobody has made a dent in Google search. They are the clear market leaders there. In fact, you could say they're a monopoly there at 90% market share. And I don't foresee market share being taken away from there anytime soon. I did an extensive deep dive into Google a few months ago. Check out that video below. I explain why I think Google's market share in search is safe. So Google's at $163.24 right now. And I'm going to keep buying Google up until about $180, $190. I think there's a lot of room left for Google to go on a very nice run over the next decade. The last thing I'm buying is JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF. I normally discuss individual stocks on this channel. However, I have been buying JEPQ now for quite a while. Part of the reason is it's a part of my strategy to really create a large portfolio of passive dividend income. JEPQ has an excellent yield. It says here about 12.5%, but it's really closer to about 9 to 10% based on the last dividend. The other thing is they pay dividend monthly. So you're getting that income every single month. So this is a part of my larger passive income portfolio, and it's the only fund outside my 401k S&P 500 index I actively DCA on a very regular basis. I don't care if it's up, down, what the ETF is doing. Every 2 weeks, I buy shares. What is JEPQ? What is their actual strategy? And why can it deliver nearly 10% yield? Well, it utilizes a strategy based on covered call options. So in this strategy, JEPQ, it holds stocks that are in the NASDAQ 100, and simultaneously, it sells call options on those stocks. The call options, it gives the buyer the right to purchase the stock at a specific price. That's called the strike price, and that happens before a certain expiration date. In exchange for this right, the buyer pays a premium to JEPQ, and that's the source of the income for this fund. However, if the price of the underlying stock, it goes above that strike price, so the fund, it's obligated to sell that stock at that price. So it does cap the upside and share price appreciation. But that's really not the point of this fund. It's not about untapped growth. It's about generating a very high yield, high passive income stream for its investors. But what's also very good about the covered call strategy is it provides some downside risk mitigation. So if the market's falling, the premiums collected on writing these calls, it helps to offset potential losses by the underlying share positions. And since it focuses on the NASDAQ 100 stocks, it's writing these covered calls and investing in very high quality businesses at the outset. So I like it because it gives a great yield and it gives exposure to the tech industry, which I believe by far has the best potential of growth, not only in the United States, but in the world. If you notice my watch list, very tech heavy. So this is an ETF. It's not going to have the same type of growth as the NASDAQ, but it will have steady, reliable growth with a great dividend to boot. So that's a high level look at what I'm looking at right now, what I'm currently buying right now, and my reasons for buying, as well as waiting on certain things. I certainly appreciate the excellent growth the S&P 500's had over the last year, over the last couple years actually, but I'm also bulking up my cash reserves for that potential drawback. Not necessarily in the market, but in some of my favorite businesses on the watch list right now. Remember, I'm never going to try and predict the market as a whole. I think that's impossible and a complete fool's errand. I'm just going to focus on putting my money into high quality businesses that I believe in the long run will grow faster than the market and enrich investors along the way. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.